Okay, so in this part of the lecture, we basically have like an illustration example. Basically, it reads as follows. It's a company, it bought some items and they were processed as per the whiteboard. Let's just quickly maybe read through the actual scenario. And it's assumed that the company is a VAT vendor. Please just keep that in. ABC Pty bought the following items for its manufacturing division. So that tells us that it's a taxable supply. The scanning detector for diamond fragments underground. That's the first item bought. Diamond refinery machine. That is the second machine that was bought. Digital camera for capturing fragment captions. That's the third. Drones used for scaling minefields. Fourth, toaster for canteen use. That's the fifth item. So they bought 5 items. So on the right hand side, we've got items which were generalized, and in this instance, they're basically dotted down in green. So the first item that we have is a diamond refinery machine with a debit entry of 200,000, followed by digital camera 120,000, scanning detector 100,000, drones 250,000, automated toaster 80,000 rands, and we've got a VAT input of 97,896, and we've got a bank amount of 750,000 rands. So to basically see if they recognize VAT for all of these line items, obviously with the bank amount, that would obviously tell us the aggregated value of all the items that were bought. So maybe let's take that 750,000 and apply our VAT fraction and see if they recognize VAT for all of the items. So we're going to go on and say and the answer that we get for that is 97,826, which is the same VAT input that we've got on the whiteboard. So we'll just basically go on now and assess as to whether every single one of these line items was actually able, or was it was actually correct in them having to recognize and input VAT for every one of these items. So diamond refinery machine, is that a taxable supply? Yes, it's a taxable supply. Taxable supply. Digital camera, yes, it's a taxable supply. Manufacturing. Scanning detector, yes, it's a taxable supply for the same reason, used for manufacturing. Drones, yes, it's a taxable supply, which is also used for manufacturing. Automated toaster. With that one, we have to take a backseat a bit and just basically analyze it a bit. What is a toaster going to be used for? It's going to be used in the canteen. So what do we know about the canteen? The canteen is where people go, or employers or employees, they go eat there. And what is eating? Eating is basically connected with something that we enjoy. And what is something that we enjoy so far is the understanding that we've so far kind of like come to understand so far is that something that we enjoy is entertainment, and entertainment is a denied supply, except where the exception is applicable. But here the exception is not applicable because this is a manufacturing division, so there's no exception there. They're not in the entertainment industry. Therefore, this toaster should not have been given, should have not recognized rather VAT input. So we therefore have to correct that ledger account or the control account for VAT input basically. So in having to correct that, we know that we're going to have to actually put a debit to somewhere and put a credit to somewhere. And we will call this correcting journal. Call this correcting journal. Okay. Correcting journal, just put it like that. Okay. So we know that the VAT input ledger account, where it's sitting right now, it's obviously overstated by the amount which which would have been recognized as VAT input for the actual automated toaster. So therefore, the actual account that we know we have to correct would be that VAT input account. So VAT input has to be adjusted. And we adjust that by having to put through a credit entry because we basically recognizing the original debit entry in the VAT input control account, right? So that we know we're going to do. The maths will follow later. So what would also get the debit entry? The debit entry will now have to go back to the actual automated toaster because it does not have any VAT input that it should have recognized initially. Because these are the two accounts that would have been affected as a result of the error in recording or recognizing rather VAT input for something that we've just discovered is actually a denied supply. So what other students would have gone on to do in this scenario, they would have actually gone on to actually recognizing the whole 80,000 rands of the toaster by crediting the toaster 80,000 rands and coming back and debiting bank 80,000 rands. You know, it ends up being a mess because and maybe coming back as well and crediting VAT control. I don't know what they would have even credited, to be very honest. In that instance, it's very wrong. Even if you're to get to the same result, but at postgrad level, you would not be marked correct if you're going rather to actually having to de-recognizing all those amounts like I've just illustrated, because it's not you dealing with the actual account that has an error. The error is within the VAT control account, which is the VAT input in this instance. So we basically correcting this input account by having to credit VAT input. And we know that we now have to debit back the actual amount that was originally recognized as VAT input by having to now debit that portion of the VAT input to the actual automated toaster. I'm just going to put it here. Then you can actually work out the actual amount that would have been as a result of VAT times 80,000 rands. And we know that the actual amount now that would have been recognized as a VAT, as an aggregated VAT within this whole amount of 97 inclusive of the toaster would have been 10,000 rands for the toaster, 10,435 would have been the actual overstatement. And now the actual control account for VAT is now in alignment because we've not gone on to recognize input VAT for something which was a denied supply. So it's totally right to actually do it in this manner, whereas with changing news to actually bring down VAT input, we would have had to go on to process a VAT output. Changing news, totally different. Here we're dealing with the actual account which is overstated, which is the actual account which is sitting with an error. In that instance, it's the input control account which is overstated by 10,400 and odd because it's for an automated toaster which is a denied supply that would have never had to recognize that input. And just be mindful of that. And these are just the bits and pieces that you can come across in a tax situation, and this could be in an examination, or you can get a company making wrong recordings, and these would be situations that accounting officers would have to look out for, and your auditors would be coming after you if they see such errors, because you would have basically cost SARS to be out of pocket, because sometimes some of those officers would miss such things. So you as an accounting officer can afford that. So be mindful of that. And that's basically where we are. All right then.